Well, good afternoon. My name is Paul Gregg. I'm the Executive in Residence and Assistant Chair in the Department of Finance and the Dr. Phillips School of Real Estate. One of the courses I teach is Personal Finance and Investments. And at the request of the Honors College, I'm going to give you a summary of one of the lectures I give in that course on individual income taxes. So one of the things I try to emphasize to students is that understanding taxes is critical to wealth accumulation. Our tax system is complex, and understanding it helps individuals make better decisions with their money and how they invest it, and to minimize taxes as they go through life. Now, we have a very interesting history for this particular topic. Taxes have been around a long time. If you think of the Bible and all of the mentions of tax collectors and the Romans and the wars that resulted, so taxes have been with us as a people for a very long period of time. And with respect to the United States, our first national tax was an excise tax on whiskey that was passed in 1791. They wanted to use the receipts from that tax in order to help pay off the debts of the Revolutionary War. And you may recall from your history books, the people in Western Pennsylvania weren't too happy with that. They had a whiskey rebellion, and they tarred and feathered the tax collectors, if you can imagine that happening today. And we had roughly 500 people that were protesting. And George Washington, our first president, sent in the militia with 13,000 troops, and that seemed to solve the problem right away. So taxes have been around a long time in our country as well. More recently, during the Civil War, Lincoln implemented the first income tax to help pay for the cost of the Civil War. And that tax expired in 1872. And after that, the country was developing its industrial base. And one of the things that smaller countries do, emerging countries do, is they impose tariffs. Back in the news today as well. But the United States imposed tariffs on goods, which essentially was like a national sales tax. What that meant was that the manufacturers here in the United States could price their goods just below the tariff level. So if you wanted to import furniture from Europe, it was going to have a steep tariff, and that allowed U.S. manufacturers of furniture to price their goods just below the tariff. And believe it or not, that allowed them to make a lot of money and to grow our industries. It is very difficult to realize that because these manufacturing barons were able to make so much money, the American public wanted an income tax. It's very hard to conceive of today. But the Americans thought that was very unfair, and that these very rich manufacturing individuals should pay for part of their wealth as in form of an income tax. So Americans wanted an income tax. And the tax was passed in 1895. So that was our new income tax that was passed after the Civil War. Ultimately, the Supreme Court ruled that it was unconstitutional. And if you recall from your basic civics that if something's unconstitutional, there's one way to fix that, and that is to amend the Constitution. It doesn't happen very often, but in fact, the 16th Amendment was proposed in 1909. They proposed a top tax rate of 6%, and that amendment was approved in 1913, received approval from all the states required by the Constitution. So it is now part of our Constitution. And let's just take a look at it very quickly here. I'm going to read the entire amendment. Congress shall have the power to lay and collect taxes on incomes from whatever source derived, without apportionment among the several states, and without regard to any census or enumeration. That was adopted February 25th, 1913. The reason I show this to students is I want to make sure that whenever a student encounters an individual who claims that they're not paying their income taxes because, in their opinion, it's unconstitutional, I would like you to explain to that individual you have, in fact, read the 16th Amendment, and there's no question in your mind that taxes are constitutional. We passed an amendment to make sure it was clear that taxes are constitutional. Interestingly, the U.S. tax system is different from the rest of the world in that we tax the income of our citizens wherever they may live in the world. So if you move to Australia, you still need to file a U.S. tax return. You might be given credits for any taxes you pay to Australia in the form of foreign tax credits, but in any case, as American citizens, you will always be required to file an income tax return each year. And to look at the bigger picture of federal income taxes, the two biggest taxes collected of the total of $3 trillion collected in fiscal 2018. The two big ones, of course, are the federal income tax, $1.5 trillion, and payroll taxes. That would be Social Security and Medicare coming out of our paychecks, which is also matched by our employers. That's $1.1 trillion. Business income taxes, $200 billion. That's not very big at all. Excise taxes are still around, still on whiskey, still on gasoline, and things of that nature. And the estate tax, almost no one pays the estate tax. There are plenty of ways around that. Or many very rich individuals simply give all their money to a charity and avoid the estate tax. And the final item you can't see here would be gift taxes, which are negligible. Anyone interested in these statistics can go to the IRS website and Google tax stats. The IRS does a great job of compiling all of the data from our tax returns and condensing it down to an Excel sheet that would break out different income levels. For example, we can't see any one individual, but we can see composite-wise how many people had taxable income in, say, excess of $1 million. So what Congress and the president do is what we call fiscal policy. They raise money, that's impose taxes, and they spend money, and that's called fiscal policy. And fiscal policy is used to encourage us as citizens to adopt certain social behaviors. For example, home ownership. So Congress would like the public to buy a home. We want to give you some tax breaks if you do. It's done through the tax code, the Internal Revenue Code, which is part of the federal law. And you will get some benefits. You'll be able to deduct your interest on your mortgage and your property taxes. However, Congress does not want to encourage people to borrow money on their credit card. And so if you looked at the tax law, and it is 72,000 pages, by the way, the tax law does not allow anywhere in those 72,000 pages for an individual to deduct interest on a credit card. That's considered bad social policy. We don't want to encourage our citizens to go out and borrow money on their credit cards at very high rates of 18, 20%. So we're not going to let you deduct it on your tax return. However, it is good social policy to encourage our citizens to save for their retirement. And so we have a number of ways that we can do that, and it's typically embedded in the Internal Revenue Code. For example, a 401k account is a section of the Internal Revenue Code, 401k, that allows you to save on a tax-deferred basis and then pay the taxes when you retire at a later date. So let's go through the tax process. This is where we are right now in the cycle. Everyone's compiling and getting their 2019 tax form ready to go if you haven't filed it already. So we need to get a hold of our W-2s. We need to get a hold of any 1099 sent to us by individuals who have paid us, or 1098s for things like mortgage interest paid, etc. And students should understand that the IRS is essentially auditing every tax return. The system is wired essentially so that individuals that pay other individuals income that would be taxable must report that to the IRS. And then the IRS will match that income against your tax return. And so employers will send all of the W-2 data to the IRS, and they'll send a copy to you, and you're responsible for filling out your tax return. Brokers do the same thing for any dividends or interest or tax transaction or stock transactions you might have. They will report that to the IRS. Banks will report the interest they pay to you to the IRS. So everything is wired, and if the IRS sees that an individual or company has said they paid you and you didn't report on your tax return, you will receive a letter from the IRS. You will never receive a phone call indicating that they're about ready to sue you or send you to jail. That would never, ever happen. Instead, you would receive a letter and you would know it's a real letter. because it would likely say, oh, we see this employer paid you X during 2019, and we didn't see that you put that on your tax return, and it'll become obvious to you right away that, yes, you forgot to put that on your tax return. You remember that's the person you worked for last year. It'll be pretty obvious that it's a real letter. All right, so to go through the tax return process, the first thing we need to do is to select a filing status. And the filing statuses are a number here. There are 5. And most people are either going to file single, married, joint, or married separate. There's also a head of household and qualifying widower. This is what the tax return form looked like in 2017. Notice it's a pretty long form. And part of a new tax act that was passed in late 2017 was to simplify the form. Frankly, Congress was a bit disingenuous because they simply cut the bottom of the form off and created a new schedule where the bottom of the form was. So their goal of getting a tax return on a postage stamp is not quite there yet, for sure. But this is what it looked like. And then if you look at 2018 and now 2019, this is what it's going to look like. Notice it's condensed, but that bottom part has been put onto a separate form. Here we are for 2019, and you can get an idea. It's already starting to grow a bit from the 2018 model. At the top, you're going to put your name, address, and social security numbers. It's very critical that you make sure that all the documents sent to you have the correct social security number on it, and it will match against your tax return and the social security numbers you're listing up here. Now, in 2017, before the new tax law was passed, taxpayers were allowed to deduct $4,050 for each dependent. We call that a personal exemption. It's been around as long as I've been filing taxes as an individual. But beginning in 2018, we no longer get that deduction for dependents. And instead, the standard deduction was increased substantially. They did offset the loss of the deductions through additional credits, like a child tax credit. I'll talk a little bit more about that. In any case, though, the reason that all of us got Social Security numbers, at least everyone born after 1987, got a Social Security number soon after they were born, is your parents needed to have that Social Security number to put on the tax return in order to qualify for this exemption of $4,000. And the IRS matched it against the Social Security records. So this is where you would list your additional dependents. So a typical return for a married couple, you're listing yourself and your spouse at the top, and then your kids in the circled area here. Those would all be your dependents. They are still required to be listed along with the Social Security number. That would indicate whether you might be qualified for one of these child tax credits that are now exist. Now, question is, do Americans cheat on their taxes? It's very hard these days to cheat on your taxes because of the way the matching program works. But prior to 1987, there was no requirement that you have a Social Security number for a dependent. And that is the year, 1987, when the IRS first required that individuals list a Social Security number. Everyone went out and got a Social Security number for their kids. And lo and behold, 7 million dependents disappeared in 1987 compared to the 1986 tax year. Tragic. And of course, did we all of a sudden have 7 million kids die in 1987? Of course not. What was happening is people were claiming all sorts of dependents, probably including their dogs and cats, as qualified dependents, and the IRS once again tightened the loophole so that that data will be checked against Social Security records, and of course you have to produce a birth certificate in order to get a Social Security card. Now, the way the system works is that we pay taxes based on our taxable income. That is not the number on your W-2, assuming all of you have worked on a job and received a W-2. So what I've created here is a bubble chart that kind of walks you through how do we get from gross income to taxable income. It's a multi-step process. So let's start with gross income. What is income subject to income tax? Is a typical question I get as a CPA. And the answer is Congress has written the law so that everything is taxable unless it is specifically excluded in the law, meaning that if you cannot find an exclusion for something you may be taxable, it will be taxable. If you do a bartering transaction and you exchange your services for somebody else's services, that is a taxable transaction. It needs to be reported, and the IRS actually has a form on bartering transactions. So qualified scholarships, for example, are not taxable because by law, they are one of those items that's excluded. Well, what else is excluded? That's a typical question at this point. When your employer pays health insurance on your behalf, typically most of the cost of the health insurance of an individual, a small part is paid by the employee, the biggest part is paid by the employer. That is a tax-free benefit, even if the employer paid $10,000, $15,000 for your health care. That does not show up as subject to income tax. If you are the beneficiary of a life insurance policy, no tax. It is not subject to income tax. Gifts and inheritances received are not subject to income tax. Athletic facilities provided by your employer. So your employer provides a gym. Instead of having to go pay LA Fitness a monthly fee, you have the benefit of a gym provided by the employer at the employer's cost. That is a tax-free benefit. Personal physical injury awards, not taxable. Scholarships and fellowships, as I said, not taxable. Workers' comp payments. And interestingly, company paid parking up to $270 a month. And you might wonder, well, why up to $270 a month? That's because Congress does not want to pay taxes on the value of its parking benefit. If you've ever been to Washington, D.C., you notice that the members of Congress park right behind the Capitol there, and the IRS has determined that the value of that parking benefit is $270 a month, which Congress quickly writes into law to say, oh, by the way, up to $270 a month is excluded. Thank you, IRS, for letting us know what it is. Now, gross income, of course, for most individuals is going to be what you earn on your salary. We call that earned income. It's going to show up on your W-2. And there's a way to calculate income. And I've kind of summarized this here. I've kind of shifted it to the top left so you can see all of it. Let's assume you make $50,000. Then that $50,000 is certainly subject to tax this year. If you save 3%, that would be $1,500, and put it into your 401k, that would be tax deferred income, and your $50,000 would be adjusted by that $1,500 in what's shown to the IRS. If your employer matched that with another 3%, that shows up nowhere. It goes into your 401k account, and it will grow over time until you retire. And you don't pay taxes on that until you take it out at retirement. So it's tax deferred. Your health insurance premiums would be adjusted on your income. So that's tax deductible. The employer's share of that, let's assume they paid another $1,000 in addition to your $100 a month or $1,200 a year. The employer's share will be tax-free. The Social Security that you pay, that would be $38.25 at 7.65%. For Social Security and Medicare. Your employer matches that. That comes out of your paycheck. You're paying that tax today, and you'll get that money back when you retire at full retirement age of 67. And your employer is also matching it and giving the total of the two to the U.S. government. You save half, 7.65. Your employer matches half. So the total is 15.3%. And when you receive your annuity when you retire, it will then be taxed up to 85%. Doesn't seem quite fair, but remember, while the money was taken from you and your paycheck, you never paid tax on the match from the employer. So the compromise that Congress came up with is that, okay, not 100% of your Social Security to be taxable, but we will tax up to 85% depending on your income level. So here's what a W-2 might look like. And notice in my example here of someone making $50,000, that if they contributed $1,500 to a 401k, notice it's listed in box 12A as $1,500. They've subtracted the $1,500 from the $50,000, and what you show the IRS is $48,500. Had this illustration, an employee had paid any health insurance, then that would also have been deducted. They didn't show it for this particular example, but it would be deducted as well. And on the right there, on box 2, you will see that this individual withheld $68.35. That's based on what you tell the employer to withhold on a form called a W-4. The W-2 will also capture how much Social Security and Medicare tax you pay. It's 6.2% for Social Security and 1.45% for Medicare, total of 7.65%. The W-2 also captures non-taxable income, like that $1,000 that was paid on your behalf for health insurance. If you live in a state that is subject to a state income tax, that data is captured below. Fortunately, in Florida, we don't have to worry about that. So here on our 2019 1040, we would put the $48,500 on line 1. Again, this individual made $50, but we're only starting the process with $48,500. We've already saved $1,500 in calculating our taxable income. Now, tax-deferred income would include not only your 401k earnings and contributions, but if you were to buy, for example, a U.S. savings bond, interest will accrue, but it's not taxed until you cash it in. So we call that tax-deferred income. And again, the employer match on your 401k, whatever it might be, every company is a bit different, that money doesn't appear anywhere. Remember in our previous example, the employer matched the $1,500, but it didn't show up anywhere on the W-2. Well, that money is sitting in your 401k account. It will grow to a much larger number by the time you retire. And when you take that money out at retirement, it will be taxed as ordinary income. You're essentially taking it out of one pocket and putting it in another, but you're now having to pay your deferred tax. Now, earned income comes from work you do, as compared to passive income, which is income you derive from, say, investments, where you buy a stock and it pays you a dividend. You open up a savings account, it pays you interest. Both of these are taxable. And most interest that you receive is taxable, and that's going to go on line 2B. That would be interest received from your bank or any investments in treasury debt or corporate bond debt. All of that's taxable. There's one exception, and that would be interest on municipal bonds. These are debt instruments of state and local government, not to be confused with treasury debt, which is the debt obligations of the U.S. government, some 22 trillion and counting as we talk here. So if the state of Florida, city of Orlando, even UCF is considered a government agency at the state level, then any bonds issued by these entities that you might bond, the interest is tax exempt, and it's excluded from your taxable income. Dividends that you might receive from a corporation are also taxable. Here, though, there's an issue because the corporation is paying tax on the profits before they distribute them to you, the shareholder. So there are two taxes. So in order to make it a little fairer, Congress has developed a new system beginning with the George W. Bush era, where we call dividends from a U.S. corporation that's already paid tax a qualifying dividend. And those are segregated and they're taxed at a lower rate. All right. Any dividends from a municipal bond fund, of course, would be exempt, excluded. IRA and pension and 401k distributions are taxed. And you must not touch monies in IRAs and 401ks until you're 59 and a half years old. If you do, it's taxed and there's a 10% penalty. The exception would be for Roth IRAs. These are ways to save for your retirement on an after-tax basis. You don't get a tax deduction, but the money grows tax-free. Any rollovers of your 401k, and I highly recommend employees that leave their employer take the 401k money and do a tax-free rollover to a similar plan with, say, a discount broker. That number of the rollover will be reported to the IRS. It appears on the 1040, but it does not show in the taxable income line. And as I said, when you retire and you start receiving Social Security, it will show on your 1040 as taxable income, but a maximum of 85% is taxed. So here's where all of those numbers I just discussed would appear. Notice that we have interest, but we segregate out the tax-exempt interest on line 2. We have dividends, and we segregate out the qualified dividends on line 3. We have IRA distributions, we have pension distributions, and we have Social Security, and yet the amount you put on the far right might differ from the amount you put on the left, depending on, for example, if it's Social Security, the maximum amount you would put on the far right would be 85% of that. Now, people that buy stocks and bonds, those are capital assets. And when you sell a capital asset, you will either have a capital gain or a capital loss. So here we need to break out the time that we hold capital assets when we realize our gain. So short-term capital gains are gains that for assets that you invest in that you hold up to and including a year. If you hold a capital asset for a year and a day or more, then any gain or loss in that sale is called a long-term capital gain or loss. And the reason that distinction is important is because long-term capital gains are taxed at a lower rate than short-term capital gains. Other income, this is the schedule that was clipped off at the bottom of the 1040 and put onto a new schedule called Schedule 1. And Schedule 1 would show two things. It shows additional income and additional offsets to income. So let's see, here in Florida, we have no state tax refunds. That's not applicable to us. Any alimony you receive from a divorce settlement pre-2019 would be considered income. Business income, if you have a small business, you've got an online internet business, you've got to report that on a Schedule C and show the net income here on Schedule 1. Real estate income, partnerships, unemployment compensation, other income would all be captured here. And then I guess for some of you that might be receiving a 1099 instead of a W-2, you're considered an independent contractor, and that would go on Schedule 1. The bad news is because there is no employer, if you're an independent contractor, you are now obligated to not only pay your Social Security, 7.65%, but the match that the employer, that's 15.3. So not a good deal if you are self-employed on the Social Security front. What about the other deductions on Schedule 1? If you're an educator, if you're a college of education major, you're a school teacher now, you're having to buy supplies for your kids, Congress gives you a break. They let you deduct the cost of those supplies for your kids on the Schedule 1. Health savings account contributions that's used for high deductible health plans, you can deduct those. Alimony paid for a pre-2019 divorce. Whenever you make an IRA contribution, a traditional IRA contribution, you get to deduct it on Schedule 1. Not to be confused with a Roth contribution, you cannot deduct that, but the money grows tax-free. Interest on student loans up to $2,500. That's one to remember. For any student that has student loans, you get to deduct up to $2,500, subject to certain adjusted gross income limits. All right, so that's Schedule 1. You can see the additional income at the top and the additional deductions at the bottom. Now, once we take our income and we adjust it for additional income on Schedule 1 and additional deductions, we have something called adjusted gross income. And that is a jumping point for the next computations that we have here. To compute taxable income, we take our adjusted gross income, that's AGI, and we get to deduct a standard deduction, or we get to itemize. The standard deduction for 2019 is $24,400 for a married couple filing joint and $12,200 for a single individual. That really means that you've got to make more than $12,200 as a single person in 2019 in order to worry about paying any income tax. Of course, the Social Security tax will still be due. These standard deduction amounts are escalated for inflation each year. So for 2020, the standard deduction will be $24,800 for married. And of course, you can't see it because of my picture. For single people, it will be $12,400. So here is kind of the recap of where we are so far. We started with gross income. We have a few adjustments on Schedule 1 that results in adjusted gross income. And now we deduct either the standard deduction or Schedule A. So we have a choice. We have a no questions asked standard deduction, or we can itemize certain expenses. And if it's greater than the standard deduction, then we can take Schedule A. I might note that beginning in 2018, the standard deduction was doubled and the dependents, the personal exemptions, were eliminated. So that was kind of offsetting each other. Once we subtract that, then we have something called taxable income. So what are these things I can deduct on Schedule A? Well, I can deduct my medical expenses to the extent they exceed 7.5% of adjusted gross income. I can deduct my property taxes, my state and local income taxes up to $10,000. I can deduct mortgage interest on my home, investment interest that I pay to my broker because I'm borrowing on the margin, something I don't recommend people do. I can deduct my charitable contributions so long as they're made to a qualified charity organized under Section 501c3 of the Internal Revenue Code, or casualty losses. But interest on credit cards or interest on a car note is not deductible. It's simply interest on a home mortgage. So here's what Schedule A looks like for 2019. And if you look at the top, it starts with the medical expenses. So let's make this simple. Let's assume your adjusted gross income was $100,000. 7.5% of that is $7,500. The way this form is reading is that you would have to have more than $7,500 of medical expenses to get any deduction on Schedule A. That's what we call a limitation. And that limitation is scheduled to increase to 10% in 2020. The more money you make, the less likely it is that you'll be able to deduct any medical expenses. The less money you make, the more likely it is that you might be able to deduct medical expenses. Think of somebody with $10,000 of adjusted gross income with $2,000 of medical expenses. Well, 7.5% of $10,000 is $750. So they would get the difference between $2,000 and $750 on Schedule A. Next would be the taxes you pay. State and local income taxes are not applicable to us here in Florida, but we would be able to deduct our personal property taxes. Now, part of the new law capped these taxes at $10,000. Didn't affect most people here in Florida, but I'm here to tell you, people in the Northeast, people in California who are paying a lot of state income taxes and a lot of property taxes easily pay more than $10,000, and they essentially lost a deduction. I guess the response would be, well, we doubled your standard deduction. That should help make up for it. But I will tell you, people in the Northeast that have high taxes and high property taxes on their home are very upset about this SALT limitation, state and local tax limitation. It's a big deal. On the interest that you pay, again, your home mortgage interest is deductible, but only up to a mortgage of $750,000. Prior to the new tax law, it was up to $1 million. So they restricted that mortgage interest deduction under the new law. Interest on a home equity loan, which you can't see because of my picture here, what that says is that it used to be you could borrow on the equity of your home and it would be tax deductible like mortgage interest. However, the rules got tightened to say you must borrow the money to expand your house. You can't borrow money on a home equity line of credit and take the interest as a tax deduction on Schedule A. I know this gets pretty complicated. All right, so let's take a limit again, a look at the limitation. On $100,000 of adjusted gross income, you had $5,000 of out-of-pocket medical expenses. Again, $7,500 would be the limit. So you would get 0 medical deductions on Schedule A. But if your medical expenses were $15,000, then you would get $15,000 minus the limit of $7,500. You would get to deduct the difference, $7,500 on Schedule A. Now, the new law tax impact will be, of course, that a lot of people won't be able to file Schedule A because they're limited to $10,000 on their state and local taxes. And if you are in a high tax state, you are going to pay more federal taxes. From the federal side, I think the politicians would say the federal government has been subsidizing the high cost states by allowing a full deduction of these taxes. And we think this might encourage the high tax states to start reducing their taxes rather than letting the federal taxpayers subsidize those states on Schedule A deductions. Another impact of the new law is that benefits of home ownership have been reduced. If the standard deduction is increased, it's doubled, then it's less likely that you can deduct interest on Schedule A. So let's look at a $300,000 mortgage at 5%. That would be $15,000 of property taxes, $15,000 a year, plus property taxes of $5,000. Total, say $20,000 of interest and taxes. But if the standard deduction is $24,400, I still take the standard deduction. I'm not getting any incremental benefit by filing Schedule A because the standard deduction is so high. Part of the reason the standard deduction was doubled was to limit the amount of deductions and to simplify taxes. Charitable contributions may also decline. So if I can't file Schedule A because my state and local tax deductions are limited and the standard deduction is so high, I may be less likely to make donations to my favorite charity. And of course, in the prior law, we had this personal exemption deduction for dependents of just over $4,000. If I had a family of 4, I just lost $16,000 of deductions. Well, part of that was made up through a child tax credit of $2,000, and the amount of adjusted gross income that you had to be under was increased to $400,000. So most people are going to be entitled to that $2,000 child care credit. And there's also a $500 credit for dependents over 17. That's what you can't see because of my picture. That means for all our college students, your parents, if they're claiming you as a dependent, will likely get a $500 credit. All right, so in the past, this is what my bubble chart looked like. It looked like gross income minus adjustments equal adjusted gross income, or AGI. We took the greater of the Schedule A or standard deductions, and then we subtracted exemptions times $4,000. And that, of course, went away under the new tax law beginning in 2018. So let's take a look at our tax return for our hypothetical individual. And we started at $48,500. If you recall, we're going to subtract $12,200. So my adjusted gross income in this case is $36,300. On page 2 of the 1040, we would calculate the tax due. I'm going to show you how to calculate that in just a minute. We would compare it to the tax withheld that's documented on my W-2. Remember, that was $68.35. And since I paid more than the tax due, this individual will get a $2,600 tax refund. If you underpay substantially, there could be penalties and interest. The government has wired this such that you cannot pay all 100% of your tax April 15th. You must make estimated payments, and if you're short, and there are a number of rules that you have to go through to make sure you paid enough in, then you're going to end up having to pay interest and penalties. Your W-4 should help you figure out how much to withhold on your paycheck. Now, the U.S. tax system is a progressive system, meaning that the more you make, the more you pay. And each level of income is taxed at a different rate. It's not an average rate based on your taxable income. It is an incremental tax based on different levels of income. I know there's been talk of a flat tax, but generally speaking, flat tax has not been well received since it is not progressive, and it disproportionately helps people at higher income brackets versus lower income brackets. This is a summary of tax brackets going back to the Bill Clinton era, which is the light blue on the left bar here. After Bill Clinton was president, George W. Bush was president, he dropped taxes, something that typical with a Republican president in Congress. They tend to like to drop taxes. So the brackets you can see were set up, and brackets 3, 4, 5, and 6 were dropped under the Bush tax cuts. When President Obama was elected, we went to the gray bar, and he campaigned on increasing taxes on the rich. So he essentially went back to the top bracket that we saw during the Bill Clinton era of 39.6%. And subsequent to that, of course, we had a Republican Congress, Republican president with Trump. They dropped it back to a lower bracket. That high bracket now is 37%, not 39.6%. During President Obama's time, we also passed a new investment tax of 3.8%, plus another Medicare tax of 0.9% for high-income earners with lots of investment income. It's like $250,000 or more subject to that tax. Interestingly, when the Republican Congress cut taxes in 2018, they left that 3.8% investment tax to pay for the Affordable Care Act intact. I thought that was interesting. But from a big picture perspective, let's look at tax rates since the 16th Amendment was passed back in 1913. This is a chart from the St. Louis Federal Reserve. Anyone interested in doing research, economic research, this particular Federal Reserve Bank has tremendous amounts of data that can easily be cut and pasted into a PowerPoint or whatever. And this particular one shows the highest marginal tax rate over time. And amazingly, in the 50s, can you believe the U.S. government had a maximum tax rate of over 90%? It's just phenomenal. So the arguments today, if you look at the far right where the arrow is, about whether the top tax rate should be 39.6 or 37%, from a historical perspective, it's nothing where it used to be. These are arguments at the margin as opposed to proposals to increase tax rates to say 70 or 80%. So let's take a look at these tax rates. These are 2019 tax rates for single and married joint. So for example, let's look at a single person. If in fact you have positive taxable income after your standard deduction, then you will pay 10% on income up to $9,700. For a married couple, it's $19,400. And you can see how it goes. Each level of income is taxed at a different rate. And you don't get into the top rate, which again is 37% now, until you're over $510,000 as a single person or over $612,000 as a married person. I mentioned the long-term capital gains rates were lower. If you hold a capital asset for a year and a day or longer, then you would pay a lower tax. And here the really good news is for single and joint married, that if your taxable income is between 0 and $38,000 or $77,000, there's a 0% capital gain rate. Can't get much better than 0. Most people, though, are going to fall between the next line, those brackets, and will pay 15% on their long-term capital gains. And if you're in the 400,000 plus bracket, then you're going to pay 20% on your long-term capital gains. That was an increase that was put in place with President Obama. All right, so let's calculate tax on a hypothetical individual here that had $72,000 of wages. However, they put some money into their 401k, and they had some health care premiums that they paid to their employer. Those all get deducted. So the IRS only sees $62,200. This individual gets a $12,200 standard deduction. So now their taxable income has moved from $72,000 down to $50,000 before we even calculate the tax. And when we do calculate the tax, it works like this. The first $9,700 as a single person would be 10%. That's $970. And then the next bracket or bucket of income is taxed at 12%. And anything over $39,475 is taxed at 22%. We add them up, and that total is $6,858. The average rate would be 13.7%. So let's do another illustration. The last one we looked at, the marginal tax rate, the last dollar was taxed at 22%. The effective average rate was 13.7. So one more dollar of income, this individual would have paid 22 cents in tax. But for $100,000 of TI, that's taxable income, let's look at the amount due. All of a sudden it grows, when we double it from 50 to 100,000, it grows to 18,174. Notice that because this individual has got a lot more income in the 22% bracket and now has moved to the 24% bracket, the next dollar of income for this individual is going to be taxed at 24%. And the average rate is 18.2. So for our second individual, our marginal rate is 24% and the effective rate is 18.2. So double the income, you notice that the tax didn't double, it more than doubled. It went from $6,800 to $18,000. That is how a progressive tax system works. And again, these brackets are adjusted for inflation each year, which is certainly beneficial to make sure we're not paying taxes on inflationary gains in our income. Another tax stat that I got from the IRS website would be how much tax is paid by people in different brackets. And interestingly, for brackets over 500,000 of taxable income, 1% of the taxpayers pay 22% of all the federal taxes. The top 3% pay 44%. The top 15% pay 72%. And the top 54% pay 98%, meaning that the bottom 46% of taxpayers pay very little, if any, tax. In fact, they can get money back. I know there's a lot of debate on wealth disparity. And so typically it involves, are the rich paying enough tax? Well, certainly this indicates they're paying a lot of tax already. The question is, should they be paying more or not? Now, for taxpayers, the thing that you should know is that the average tax rate that I just calculated is interesting, but it's not particularly helpful. It's not really meaningful, except when I say here for politicians. When Mitt Romney ran for president, he did disclose his tax returns. His average tax rate was 15% because he was getting most of his income from long-term capital gains on a hedge fund. And so that was before the rate went to 20%. So that got everybody all excited about how much money he made and was only paying 15% tax. But really what we need to know as taxpayers is, what is our marginal tax bracket? What is that next dollar of income going to be taxed at? Or what is that next dollar of deduction that I might give to a charity? How much can I save in taxes? Now, a tax credit is different than a tax deduction. A tax deduction is part of the adjustments to get to our taxable income. A tax credit is dollar for dollar. So if I get a $2,000 tax credit, then that means that I subtract $2,000 from the tax I owe. I get all of that money back. So let's take a look at the deduction versus a credit. Let's assume I've got a taxpayer who is filing Schedule A. They decide to make a $1,000 contribution to their favorite charity on December 31st. This happens a lot. What is the impact on taxable income and how much tax is saved? In this case, because Schedule A would go up another $1,000, that means taxable income would drop $1,000. And if this individual is in a 24% bracket, they just saved $240 on their taxes. However, let's look at an individual with taxable income of $60,000 and a tax due of $9,000 and is entitled to a $2,000 child care credit, child tax credit. How does this change taxable income? Does not change taxable income. Instead, the $9,000 that is owed is reduced by $2,000, and now this individual owes $7,000. So you can see the benefit of a credit is much greater than the benefit of a deduction. So when you're done with your tax return, you want to, of course, sign and date it. And I would always advise taxpayers to have their refund sent directly to your bank. And of course, in my example before, remember we had someone with $50,000 of taxable income. They they owed $68.58. If the taxpayer withheld $78.58, then they're getting a $1,000 refund. And in this case, you could ask your employer to withhold more or less. If you wanted a bigger refund, you could withhold more for the next year. Or if you wanted to get a smaller refund and have the money come to you on your paycheck every 2 weeks, then you can adjust the withholdings down. So I asked the class at this point in the lecture, what is better off, getting a bigger refund check or owing money April 15th? And the answer really is, it depends. And so if you are a spender and you have a hard time saving money, over withholding is a great way to save money. Now, the federal government does not pay you interest on that savings, but it's a way to save. If you could not do otherwise, it might be a way to save. And of course, if it was in the bank, it's not earning much today with very low interest rates. However, if you're a saver and you can employ that money and get a higher rate of return, then savers often who can manage their taxes would like to owe some money, and they've had the benefit of that money throughout the year. The only problem with that is you have to be very careful that if you end up owing too much, you will be subject to interest and penalties, which will wipe out any benefit that you may have received by investing the money during the year. Now, here's an update on this tax deadline issue, and this is a fairly recent update, March 21st, where because of the COVID virus and the fact that tax preparers and taxpayers are all sheltering in place, so to speak, the due date for taxes has been extended for everyone from April 15th to July 15th. So that's a 90-day extension. And if you were subject to quarterly filing, that's one way the IRS makes you pay enough in, you would have had a quarterly filing for 2020 due April 15th. That got deferred until July 15th. You do not need to file an extension. Normally, if you don't pay your taxes on the due date, you need to file a form 4868, but the IRS is ruling, hey, no forms required. We know we've extended it. We don't want every taxpayer sending us all these crazy forms. But if you need a further extension after July 15th, you can then file the form 4868, and that's how you do it. Now, when you file for extensions and assume you owed money that April 15th, you can defer that until July 15th, and the IRS will not charge you interest and penalties. So that's a free loan. But if you do owe money July 15th, then you will have to pay that. Either file your return and pay it, or pay it and file an extension. If you don't pay it with your extension, then interest and penalties would apply from July 15th on. I recommend individuals use tax software. You can go to the IRS website. Most students don't make enough money such that a lot of these software packages are free. If you make more than X, sometimes you'll have to pay for it because your return is more complicated. But I highly recommend taxpayers use this free software. Personally, I use TurboTax, and I have a more complicated return, but I've been using it for many years. It downloads from my Quicken software, and it's very easy to do. I can go to my broker, download all the data from my stock sales. The broker has split it between long-term, short-term capital gains and losses. It's all done for you. It's all automatic. It's very simple. And even though I'm a CPA, I would never try to do my tax return by hand. I would always use tax software because it's just too complicated and it's too easy to make a mistake. Now, if you owe money to the government, you need to make your check payable to the U.S. Treasury and keep a copy of your return. I like to keep PDF copies of all my tax returns, and that's a great way to go. I also file electronically. Originally, I was a bit hesitant to file electronically because all your data is going out somewhere, but the IRS has a reasonably tight system where they ask you to verify yourself by, for example, putting in your driver's license number, which they have on file. So they more or less know it's you when you're filing the return. But of course, if you owe money, you still need to send them a check in the mail with an appropriate piece of paper so they know where it's coming from and what it's for. All right. If you owe money, another trick of the trade for those of us that do this for others is that if you owe money and it's a lot of money, you definitely want to get certified mail return receipt requested. So if in normal times, if you owed, say, $5,000 April 15th, you go to the post office, you're mailing it off April 15th. As long as that stamp says April 15th, even if the IRS gets it 2 weeks later, you're good, no penalties and interest. But one way to verify that they got it is to make sure you get a certified mail return receipt requested. You now have backup documentation, and you'll get a receipt from the IRS that they actually did receive it, and you should be good. That avoids any disputes on whether penalties and interest are due because you allegedly mailed your return late. Let's see. As I said, quarterly payments may be required. So if you've been short, and you probably would be subject to interest and penalties because you did not pay enough in, you owed way too much money, then the IRS will put you on this quarterly payment plan, which is due April 15th, June 15th, September 15th, and January 15th of the following year. And again, fortunately, that April 15th date has been extended because of the COVID-19 situation. Talk a little bit about tax audits. I mentioned earlier that the IRS computer is automatically matching all of our data against your return and sending you a letter if it doesn't match. So everybody gets audited, but there's a next level of audits where you may be called down to the IRS office, or they may come out to your business, or you may get a letter audit asking you to provide support. So not a lot of returns are audited that way, about 1% or so. But what will trigger an audit is when you have unusually large deductions. Again, my tax software, TurboTax, at the end of the return, it actually shows me for my income bracket what the average deductions would be for my income and whether it's likely I would be audited. So for example, if I was filing Schedule A and people in my income level were deducting on average $30,000 on Schedule A, and yet I deducted $125,000 on Schedule A, then that's going to be a red flag and may be subject to audit by the IRS because I'm way out of the zone, and my tax software would warn me about that. Okay, you do have audit rights, but I think the real lesson on dealing with the IRS is you do not want to upset the IRS. They can be a serious thing to deal with throughout life. If the IRS is constantly at you, they can garnish your paycheck. They can put a lien on your home. They have tremendous power, and really citizens are best to comply with the tax laws and do everything you can to make sure you're on the good side of the IRS. Now, some things that we can do by way of tax planning strategies would be first to project, well, what's going to happen next year? Will taxes go up or down? And by now, you should see that whenever we have Republicans elected, taxes go down, and whenever we have Democrats elected, taxes go up. That's kind of the nature of the beast. So if, for example, the Democrats win, I would certainly guess that 37% maximum tax bracket might go up. And for high income people, taxes might go up. That's certainly what happened with President Obama. In that case, you would want to accelerate income, if you could, to this year and wait for your deduction. So if I'm filing Schedule A and I'm a top tax bracket person in a 37% bracket, and I'm about ready to give $10,000 to my favorite charity, and I file Schedule A, I'd probably wait until January if the Democrats were elected, because odds are the tax rates will go up and I'll get a bigger benefit by writing that check in January versus December. And if brackets are going down, it's just the opposite. You want to wait for income until the following year and pay it at a lower rate, or accelerate your deductions to the current year. So here is from the Congressional Budget Office and the Joint Committee on Taxation. Congress follows what's going on from all the data assembled by the IRS, and they know what these deductions are costing by way of income to the Treasury. So here are the big ones, starting with charitable contributions. You can see that is, I don't know, $700 billion a year, allowing the charitable contribution costs the taxpayers. Mortgage interest deduction is getting closer to $1 trillion. The break for the 401k is $1 trillion. State and local tax deduction is $1.23 trillion. And the employer-provided health care, remember that's a tax-free benefit, is a real big one. And you can't see it. It's about $2 trillion. So I've asterisked 3 of those. So when the tax laws were adjusted in 2018, Congress went after some of these deductions. They basically limited the charitable contributions, the mortgage interest deduction, and the state and local taxes by, for example, putting in the SALT limitation. So that reduced the state and local tax deduction and increased revenues. The mortgage interest deduction, the maximum mortgage was reduced from $1 million to $750,000. So they attacked that. And by doubling the standard deduction, it's likely that fewer people will be taking charitable contributions. Notice the 401k was not touched. Congress discussed whether we should limit that 401k break that we all get for contributing to a tax-deferred savings plan like a 401k, 403b, 457. And they immediately heard back from their constituents, don't touch my 401k. That's my retirement, and they let that one go. The other one they continue to look at is the employer-provided health benefits. That is a really big one. That's the biggest one. And I know it's now tracked on our W-2s. It's being looked at very carefully as to whether we should pay taxes on some of the benefit that our employers are providing us for health insurance. Now, there are 2 terms here, tax evasion and tax avoidance. And I would always advise UCF students that the golden rule applies not just at UCF, but in life. We want to be ethical citizens. We want to pay the taxes that are due. We don't want to cheat on our taxes. There are plenty of legal ways to reduce taxes by having some familiarity with how taxes work, by implementing tax avoidance strategies like accelerating income or deferring income, or accelerating deductions. All those are quite legal to do, but we really should never be cheating on our taxes. It's not only against the law, but it's not ethical. And as citizens of this country, if you don't like the tax laws, elect somebody who will change them to whatever it is that you would like them to do. But there are some people who evade taxes. That's called tax evasion. And there's some famous cases here. At the bottom left, you see Leona Helmsley. She was a billionaire in New York, owned a lot of hotels. She famously told her hired help, only the little people pay taxes. They turned her in to the Iras. There is a 10% finder's fee, by the way, for people that turn in people, and the IRS collects money. She went to jail. Wesley Snipes, next to her. Wesley Snipes went to an accountant, not a CPA, an accountant in Mount Dora, Florida, who explained to Wesley Snipes that, in his view, income taxes were unconstitutional, and therefore Wesley Snipes did not file tax returns for a number of major movies that he made, millions of dollars, based on his theory that taxes were unconstitutional. Wesley Snipes went to jail. This is how it works. And the IRS loves publicizing these cases. They want to send a message to the average person that if we will send the rich and famous to jail for evading taxes, you know we're going to send you to jail for evading taxes. So the bottom line lesson is be ethical and don't get on the wrong side of the IRS. There are plenty of legitimate ways to avoid taxes. That is legal, what we call tax planning or tax avoidance. One simple way to avoid taxes, let's assume I bought a stock and it went up. I bought it for $1,000 and now it's worth, hypothetically, $1 million. I have almost $1 million unrealized capital gain on the stock. Well, I can avoid paying taxes on that gain by not selling the stock. There's nothing illegal about that. That's simply tax planning. In the case of George Lucas and Lucasfilms, he was selling his company to the Walt Disney Company, Lucasfilm, all the Star Wars things, now owned by Disney. just before the long-term capital gain rate was being increased from 15 to 20% by President Obama. And so he sold that company about a month before the tax on long-term capital gain went from 15 to 20%. The number he sold the company for was $4 billion. And he saved 5% of $4 billion, which is $200 million, by accelerating the sale of this company to Disney before capital gains rates went up. There is nothing illegal about that. That is called tax planning or tax avoidance. So you can see, with good understanding of tax laws or having good advisors that understand tax law, there are plenty of legitimate ways to minimize taxes. But again, you should never cheat on your taxes. Some other ways to avoid taxes is to defer your income. So by putting money into a 401k, you defer taxes on that until the day you retire. That is essentially an interest-free loan the government is giving you. If I buy a savings bond, the interest is deferred until I cash it in. There are things called deferred annuities, and of course, unrealized gains on stocks and bonds. There are also tax-free investments. These are where you earn money and it will be completely tax-free. The first one being that interest on municipal bonds I discussed earlier. If you open a Roth IRA, and I highly encourage students who have enough earned income to open up an IRA if you are comfortable in putting some money aside for the next 45 years. You don't get a tax deduction for a Roth IRA. However, the money will grow tax-free forever, and it will be a very large amount of money when you retire. If you would like to save for your kids' college, you can save tax-free by setting up a Section 529 plan, and all the monies in that plan are tax exempt so long as the money is used for qualified higher education purposes. Income from a health savings account. These are used for high deductible plans, but it's a way to actually build a savings account for future medical expenses. I think young people should seriously look at these high deductible plans because they're typically in good health. They don't have many health expenditures, but your employer allows you to start building up some money there. It is not use it or lose it like a flexible spending account, and it's a great way to save tax-free. Other strategies in addition to the Roth IRA: buy a home. Again, those benefits have been diminished somewhat, but people with larger mortgages are able to file Schedule A and get additional benefits above the standard deduction. Traditional IRAs would be another way to save. If your employer doesn't have a 401k and you have earned income, you can set up your own tax-deferred vehicle called a traditional IRA. You will get a tax deduction, but when you take the money out at retirement, age 59 and a half or later, then you will have to pay taxes. I don't think traditional IRAs are a good idea for students because you're in a very low tax bracket. You're not getting much tax benefit by a 10% deduction on your traditional IRA. You're far better off to put it into a Roth. If you have tax losses, as many people are now incurring with the market down, I am a big believer in take all your tax losses you can and carry them forward when the market will start to recover. Generate long-term capital gains before rates go up, if possible, municipal bonds. And you can actually lump all your charitable contributions into something called a donor-advised charitable trust and say make 5 years of contribution in advance and then give it out over the next 5 years. That would juice up your Schedule A deductions for 1 year, exceed the standard deduction, and yet you'd still be giving the money out over a 5-year basis. Okay, I've added this last slide now that I have a list of the questions from students on taxes, and I'm going to go over these and give you some references that you can use. First question is, do you have any recommendations on books that would help teach me about taxes and how to do them? I've got a link on this slide. The first link is from the Iras website, Understanding Taxes. I think that would be an excellent publication for a student to look at. Generally, you can find a lot of information on the internet, but I highly recommend people go to the Iras website. Their publications are the most accurate and are authoritative, and so you can always rely on what they publish, and they tend to be quite good and make it in layman's terms to understand. If I support myself entirely, but I'm under 25, would I be able to file as an independent? There is no such thing in the tax parlance as independent. we have tax filing status, and this individual would be filing as a single individual. What would be the difference in filing as an independent? There is no such thing, or a dependent. Well, in order for your parents to claim you as a dependent, they would need to provide more than half of your support. And it appears that that is not the case, so your parents cannot claim you as a dependent, and you would file as a single individual, assuming you're single. How do I maximize my returns? What are the best free resources? Again, I've listed some on this slide, and I've already given some ideas on how students can maximize their tax situation, primarily through a Roth IRA. Do scholarships have to be reported? And if so, are they taxed as income? So I believe I covered that in the lecture already, but I've listed here on the reference Iras publication 970, which is for students and goes into great detail on scholarships. It is possible that a scholarship could be taxable, and that is for individuals who receive more money than they actually incur by way of educational expenses. That would be a profit, and that profit would be taxable. So that guide in particular gives you a much better indication, and your starting point for determining what your expenses are would be a 1098-T issued by UCF to all students once a year. Let's see, another question on advantages and disadvantages of being an independent. There is no such thing. The question is really, are you a dependent of your parents or not? Most students would probably be a dependent, which would allow your parents to claim a tax credit. It does limit your standard deduction. If your parent is claiming you as a dependent, you don't get $12,200 if you're filing as a single. It's much more limited. Other questions, let's see. Do I need to pay taxes on a refund I got from the scholarship? Don't know, probably not. But again, look at publication 970. I need to know more information about the refund and what it is to properly answer that question. How are taxes done for scholarships such as the Benquisto scholarship and stipends from scholarships? Again, scholarships in general are not taxable, but I refer all the students to that publication 971. The link is right there on the slide, and check it out because everyone's a bit unique, particularly if you're a foreign student. And that's our last question. I'm an international student. I've never done taxes, but last fall I worked at UCF. If you worked at UCF and you got a W-2, you probably need to file a U.S. tax return. Odds are you don't owe taxes, but it gets very complicated between non-resident aliens and who does or does not have to file. I believe it's called a 1040-NR that needs to be filed. It's a function of tax treaties between U.S. and your country of origin. So take a look at, simply go to the IRS website and type in non-resident alien, and you'll find some publications that would help you as well. So hopefully this answers most of your questions on taxes.